We're going to start in just a couple minutes. Okay, I think we're going to get started. Thank you all for joining us. My name is Blair Flicker. As some of you know, I'm the General Counsel of Insight. This webinar is part of our ongoing effort to provide value to our portfolio companies, in this instance to CFOs, general counsels, and others who deal with insurance issues that may impact the portfolio. Our reason for choosing insurance as a topic for this webinar was that the area presents a common set of risk management issues faced by all of our portfolio companies. And in this regard, our goals are to share ideas on how portfolio companies can or should creatively use insurance to protect their businesses and personnel, and to provide companies with opportunities to seek additional resources that may be helpful in this area. Today's presentation will be made by representatives of Crystal & Company, a national insurance brokerage firm that we work with. Crystal has expertise across all lines of insurance, including property and casualty, professional liability, employee benefits, and they work across all segments of the technology sector. They've advised us on our own insurance needs. They've supported investments that we've done, other transactions we've entered into, and they've served as a general resource to a variety of Insight portfolio companies. And perhaps most importantly, as is the case with all service providers, we look for the following aspects that Crystal really delivers on: responsiveness, accessibility, knowledgeability in their field, and creativity in their approach. So we're happy with them, and we're happy that they're able to lead this talk for us. Joining us from Crystal are Jonathan Crystal, one of the firm's principals, Sean Ram, who leads their technology practice, and Brian Dunphy, who leads the firm's management and professional risk group. I'm going to hand it off to Sean, who will take you through the presentation. There will be opportunities for questions as we go through it, and if your questions don't get answered, please make sure you reach out to one of us after the presentation. Thank you, Sean.
Thank you, Blair. I appreciate the opportunity to speak with everyone today, and certainly the opportunity to tell you a little bit about some of our thoughts as respects to risks that technology companies face, as well as some of the ways in which insurance can provide value and perhaps not provide value in some ways. Just by way of introduction, as Blair mentioned, my name is Sean Ram, and I have the pleasure of leading the technology practice at Crystal & Company, which is a practice dedicated to the high-tech industry. I've been with Crystal a couple years. Prior to that, I led Aon's global technology practice. So I've been quite committed to the technology industry for the duration of my career. I'm based in San Francisco, and we have built our technology practice on the foundation of innovation. As we think about technology companies and the risks they face, the one thing we know is that these risks are evolving at a tremendously accelerated rate. And frankly, in this old and somewhat stodgy insurance industry, the ability for insurers to appropriately track these risks and address the risks appropriately in insurance is limited. And so given the depth and leverage the size of Crystal, we've been able to innovate and drive some interesting insurance products that we hope provides value to our customers. I've had some interesting experiences in my life in the technology industry, which I'll draw from today. I worked on Facebook's IPO. I built the insurance company that Google's using today. I've spent time all around the world kind of evaluating technology risks and hope to kind of discuss that with you today. I'd encourage questions. I know that the platform permits you to provide questions in written form, and that's certainly something that I'll be scanning throughout the presentation. I'll ask questions from time to time and ask you guys kind of as an informal poll to hear your thoughts and address some of the needs you have today. By way of agenda, our goal today is to talk a little bit about the evolution of technology companies and how, in our experience, companies think about risk and insurance, and how as technology companies evolve, how the risk and insurance programs evolve. We're then going to spend most of our time talking about the risks that technology companies face. We'll address a few of them today. Most notably, we'll talk about some risks that we're seeing a lot of enterprise software companies face today in terms of limitation liability in their contracts. We'll talk a little bit about some of the patent risks that are going on and highlight a few others along the way. Again, I encourage questions and happy to answer any that I can. Just moving on to the next slide. Here you can kind of see just a quick diagram demonstrating the technology growth kind of versus insurance and risk. And you know, we all envision this kind of hockey stick growth that the technology industry has popularized. And so you can see on the curve here, we're comparing the revenue or employee growth of a technology company versus the way they think about insurance and risk management. Starting on the very kind of bottom left side, what we find is that the initial driver for most technology companies as respects to insurance and kind of risk management concerns, thinking about the risks a little bit, is actually entering into a lease. Now this could be something as small as a WeWork space, or it could be kind of a floor space, a building, manufacturing facility, whatever it might be, where the landlord effectively requires some insurance to protect themselves in the event of property damage or bodily injury. And so as a result, most companies at this stage purchase what most people refer to as a BOP, or business owner's policy, which is a package policy that contains most notably property and general liability. Very simple policy, very little coverage, but certainly meets the contractual needs that technology companies face. Shortly thereafter, as employees kind of grow within the company, companies recognize the need for benefits and the need for kind of human capital support. And what we find is a lot of technology companies enter into some type of professional employee organization, a PEO, where employees are generally leased to some of the notable companies around in the US, or for example, a company like TriNet, where they take on a lot of the payroll and the services that are occurring. And so hopefully that can provide a lot of value when it comes to workers' compensation. They oftentimes will provide employment practices liability, and certainly provide you some of those the skill sets that a small technology company needs, particularly when you may not have a fully onboard HR staff or finance staff or things of that nature. And what we find is technology companies really, in terms of this BOP policy and the PEO, kind of can actually last a significant period of time depending on the growth of the technology firm. As respects to the BOP, what we find is that the next purchase of insurance from a technology company's perspective is the directors and officers liability policy or the errors and omissions policy. On a subsequent slide, I'll spend a little bit of time along with Brian kind of describing this. that D&O and E&O product is generally driven by a couple things. The first one is an investment partner. Oftentimes, venture capital firms, most notably, and other investment partners will require a certain limit of D&O to be purchased to protect any partners that are taking board seats or just the management of the company. And the directors and officers policy protects kind of board members and officers against a breach of their fiduciary duty. And so you can see why a VC firm would want to make sure that was addressed. The errors and omissions policy is oftentimes required by customers. And so as you engage in the customer contracts where you're providing technology-related services, consulting services, etc., oftentimes they will require of you an errors and omissions policy. And the way you can think about that, certainly attorneys and doctors buy malpractice or errors and omissions. For a technology company, the errors and omissions policy is really a policy intended to protect against technology failure. So when your technology doesn't do what it's supposed to do and causes financial damage to your customers, that's really the notion of this policy, and that's generally where your customers will look for that policy. Kind of going up the ladder, when a company reaches, a technology company, generally what we see is between 75 and 100 employees, they move out of that PEO space and they buy their own corporate benefits program, generally done through a broker with an HR manager or even a CFO who's facilitating the purchase of this corporate benefits program. There's generally around that time frame of 75 and 100 employees, there's generally savings that occur. The concept of a PEO is leveraging the law of large numbers. You have many employees across a PEO organization, and some of them are technology companies and some of them are manufacturing companies and hospitals and others, and pooling that risk, you're able to get some advantages in pricing with benefits. At the 75 to 100 employee mark, we find that pricing advantage diminishes a bit. And that as long as you can take on the administrative burden of managing a corporate benefits program in conjunction with a partner who can provide a lot of value there, companies are able to kind of get obtain their own benefits. And as you think about the typical technology company where the average workforce is generally, late 20s and male, who don't go to the doctor a lot, that can drive a meaningful amount of savings by having your own benefits. In addition, you're able to also have your own workers' compensation program and the benefits, and employment practices liability, other things that most PEO organizations offer. So as you purchase each of those policies together, you can combine it into a package, and I mentioned that in the package property and casualty. And combining workers' compensation most notably, particularly with difficult state risks such as California, New York, Illinois, for example, again, that can drive some meaningful savings to insurance purchase. And then kind of going up the chain here, where we show kind of the international package, the large deductible. As companies grow, they obviously are willing to take on more risks, so they take a larger deductible, or we talk about the kind of a self-insured retention. They start to purchase some other specialty coverages. For example, if you're manufacturing overseas, you might purchase contingent business interruption, where if the manufacturing facility goes down, you're going to be protected for that. And then at the very high end of the spectrum, you have companies who are kind of building their own insurance companies. Earlier last year, Google started to offer personal lines insurance. Google generally knows a lot about users of Google who sign in via their browser and have a lot of information on them. And so their ability to leverage their capital and offer insurance and other kind of valuable items to the consumer is something they do through their own insurance company. And at the very large scale, a large insurance company known as a captive can provide some unique benefits as respects to flexibility and revenue generation opportunities. The fronting aspect is simply the ability to take on, you may have contractual requirements as a large company or as a smaller company but really have no desire to buy insurance, what you can do is, for lack of a better term, borrow insurance paper from a large carrier using your balance sheet as the backstop, as opposed to the insurance company. This has some expense to it, so we certainly don't recommend it for mid to small companies, but larger companies do that. The only other aspect I wanted to mention on this slide was the evolution of individuals at the company who are responsible for insurance. I mentioned the evolution on the HR side with benefits. As respects to risk and insurance, kind of the corporate property and casualty related policies, generally we find at the very front end of the spectrum with the BOP and the PEO, you may have a founder, the chairman, the CEO of a company handling insurance. As we kind of move into the D&O and the package, generally that moves to a general counsel or a CFO, depending on how a company thinks about risk. What we find is around the $2 billion range for a software company and around the $1 billion range for a more heavy asset company like a manufacturing firm, a manufacturing technology firm who's producing hardware, peripherals, product, is when the risk and insurance needs transfer from a finance department, a treasurer, or an assistant general counsel to, oftentimes companies will actually hire a risk manager. And so just to provide some insight on the types of individuals that address that. I certainly welcome any questions on this slide. I'm not seeing any, so I'm going to go ahead and move to the next slide, and we'll talk a little bit about risks and of technology companies. I like to present this slide as we think about technology companies because too often when we think about risk and insurance, we really only think about those insurance policies that are above the line, above the ground in this case, as you envision the tree as a technology company, using that analogy. And certainly, obviously, we're brokers and we understand the value of insurance, and we'll highlight these in a second, but we understand that the risk profile of a technology company is far beyond simply those 4 insurance policies that are above the ground. And we've highlighted just a few of the risks that we see below the ground that we think technology companies need to manage, right? Risks they face, risks that our clients tell us they're most concerned about, and we'll highlight a few of those risks below the ground, and certainly I'd encourage if there's any risk that you'd like us to address below the ground that you're perhaps struggling with or have some questions about or are interested in what other technology companies around the country are doing around those risks, please go ahead and use the question box and just address the risks, and I'm happy to address those. As I give you a minute to kind of think about that and address that, I'm going to go ahead and turn some time to Brian Dunphy. And we'll go ahead and just provide you a brief snapshot of the insurance policies above the ground that we highlight and what their intention is, what they do. Brian?
Thank you, Sean. Good afternoon and good morning to everyone. So starting on the right side of the tree, dovetailing into Sean's previous slide with the growth curve, we see, as Sean mentioned, on the right, the D&O products, management liability broadly speaking, and the E&O products are purchased very early in the cycle. D&O usually first, as Sean noted. You will have requirements from funds that are investing or from prospective directors that will say they need to have D&O in place prior to their sitting on the board or participating in any discussions around the company. That's common. And D&O, to put it in layman's terms, is really an insurance policy designed to protect companies and their directors and officers around risks they take in decision making. So whether it's financially oriented, whether it's in terms of negotiations around expansion into new regions or around new product ideas, investment in new product ideas, certain parties can hold you potentially liable for decisions gone bad, whether they be through minority investors or shareholders, or even if you have credit facilities established, you may be in a situation where there are creditors that are looking to recoup their investment if decisions go awry. Errors and omissions insurance, as Sean noted, generally called professional liability, has been historically attributed to doctors and lawyers and architects and engineers. And the reason for that is in the basic definition of what errors and omissions insurance is, which is it's insurance for claims alleging the failure to provide or the erroneous provision of services to others for a fee. And so how does that relate to technology companies and software companies? Well, you may provide a service or you may provide a software platform to your customers and clients in turn for whether it's a subscription-based service or for an outright flat annual fee. And if that technology or that service fails, goes down, you can be held liable if that failure is yours in the course of business. And so these insurance products, the technology errors and omissions products, will provide coverage and defense for third-party claims alleging your error or failure. As the market has evolved and people become more attuned to issues relating to privacy, as you see below the line there, privacy and the security of personally identifiable information, if you are dealing in those sensitive areas, then the technology errors and omissions policy can be adapted to provide you with certain amounts of protection if personally identifiable information or sensitive data is leaked or lost. And that's a burgeoning area. On the left side, you see what I would call the more traditional or mundane insurance products of property and liability. Property is very simple. That's physical hard assets, insurance for loss against those physical or hard assets. Liability being part of, as Sean mentioned, in the BOP policy, liability starts out, can be very small, and then can grow to be a big component if there's a product failure. That's a liability claim brought by third parties alleging the failure of the product itself, if it's a hard asset. And then there are other risks that as you grow out and become a more robust operating company, there are other risks that present that would, to use the slide as a metaphor, sprout into new branches on the tree. Sean mentioned quickly the risk of employment practices liability coverage, or the risks related to that. That's essentially protecting you for claims around your employment practices in the office, hiring and firing, discrimination, harassment. Those are very real risks that every company faces along the spectrum, and some are more pronounced than others. For larger technology companies, they are very real risks, notably because, frankly, the dollars at stake can be quite severe. You have highly compensated individuals in highly technical fields, and if they feel that they've either been discriminated, harassed, or wrongfully terminated, the money at stake can be quite significant.
Thank you, Brian. I appreciate that. As we began to discuss kind of these insurance policies above the ground, there were a couple questions that were posed. And I'll go ahead and repeat the questions, and I think I can address both of them at the same time. The first question was a request to briefly comment on the state of cyber insurance requirements for technology companies and security companies. And the second question was very similar. Excuse me. At what level do you typically see companies investing in a separate cyber liability data privacy policy? So let me go ahead and address the first question around kind of just the state of cyber insurance requirements for technologies and security companies, and really how that may influence kind of the manner in which you invest in that policy. Let me start by saying that as a technology company, as you consider purchasing this policy, we've used the term errors and omissions, technology errors and omissions, and then we've heard kind of this term cyber liability, cyber insurance, internet security, and privacy policy. There's a variety of ways in which this policy is deemed, and it's all very similar. It's all a very similar policy. This policy is modular. And so it enables a technology company to purchase For example, errors and omissions. If our technology doesn't do what it's supposed to do, we want to cover, indemnify our clients. We want to cover a privacy liability. We want to cover breach response. So we know that when personally identifiable information or private health information is compromised, that about 47 states require breach notification, require the end user, the individual's information was compromised, to be notified. Now, it's important to realize that this notification, the burden of notification, is upon the individual or the entity who collected the information. And there's a nuance there, particularly for a technology company. And so, for example, just to use a very broad application like Oracle or PeopleSoft, their HR application, if I give my social security number, kind of name, address, bank routing information to Crystal and Company, and Crystal and Company leverages Oracle software to store my information, and then Oracle has an outage or a breach and they lose my information, right? And this is independent whether it's an on-prem solution or whether it's a cloud-based solution. The burden of breach notification falls upon Crystal and Company. It doesn't fall upon Oracle and the technology company, because Crystal was the company who took my information. Now, in most technology contracts, we see indemnification procedures, particularly for privately held or private personally identifiable information. And so certainly Crystal and Company would expect Oracle to to indemnify them for this breach notification issue. And this is really important for a technology company to understand. As your clients impose upon you contractual requirements for cyber insurance, generally, they're going to use all kinds of terms, first of all, right? They'll use the cyber liability term. They'll use the errors and omissions term, the internet security and data privacy term. They'll use a variety of terms. And they'll require a host of different types of limits, right? They might require a $1 million limit or a $5 million limit. As a technology company, you need to come to the conclusion on whether you desire to purchase the coverage to comply with the contract, meaning I'm not interested in the risk transfer. I really just want to make sure that my client is comfortable that I have a policy. Or secondly, I'd like to buy a meaningful amount of coverage and really protect myself against the risks associated with this burden. And the reason I mention that is because of the modular nature of the technology errors and omissions policy, the variance on price is quite significant. So for example, if you were to simply attempt to comply with the contract, you could get an errors and omissions policy for, I'll use kind of a broad range of $4,000 to $8,000 per million of coverage, depending on the revenue size of your company. Whereas if you were looking for meaningful coverage and you really wanted to have that true risk transfer to an insurance company, and you were buying this for that reason, then you would be, the price per million for a policy of that nature could be, $10,000 per $1 million of coverage on up. And so as you come to that conclusion and discuss that with your partner, then you're able to really make an assessment regarding the investment. The only other comment, and I think I alluded to this, but the only other comment I'd like to make is that a lot of the companies you deal with impose quite stringent requirements when it comes to how much insurance to buy. Now, larger companies, Fortune 500 companies, a lot of them just have standards, and so a lot of Fortune 500 companies will just say, hey, if we're going to deal with a technology vendor, we're just going to require that they have $10 million, for example, of errors and omissions coverage, and that's just a requirement. And your contract might be $500,000 or $250,000. And your need to purchase or your exposure to $10 million of coverage perhaps is quite limited. And so in negotiations, and I recognize how difficult it can be to negotiate with a large company, but those are obviously points to bring up in terms of the risk. The manner in which you decide to purchase an errors and omissions policy is really dependent upon your goals, again, risk transfer or to meet the contractual demands, as well as how much risk you may have. What we find is that most technology companies below 50 million in revenue purchase a policy between $1 million and $10 million of E&O or cyber-related coverage. And then when you exceed about 50 million and you start doing substantial contracts and have a large number of contracts, particularly contracts that are not on your standard terms and conditions, perhaps a lot of contracts on your client's kind of paper, if you will, then we start to see a much more monoline or much more significant investments in E&O, where you're purchasing kind of unique coverages and a very tailored coverage for your company. All right, I hope that answers the two questions and provides you some insight on this kind of cyber insurance. Perhaps I'll conclude this just by saying there was a time when cyber insurance policies provided little coverage. Today, I don't believe that's the case. It is a meaningful coverage that is purchased by the vast majority of technology companies that can provide coverage for, as Brian mentioned, kind of the financial risks that you have with your customers. It can provide coverage for items like recall. If your software can cause bodily injury or property damage, perhaps you do a lot of work in the healthcare space, it can provide coverage protecting you against those risks. So there's tremendous opportunity to really tailor the coverage to your technology company. All right, I'm going to go ahead and move on just in light of time. It was my intention to highlight a few risks here. I think I already addressed privacy. I'm going to talk about IP and kind of contract liability in a minute. We addressed the cloud, and I'll talk a bit more about, SaaS-based services, leveraging Amazon Web Services or Microsoft Azure, et cetera, and kind of dealing with those types of vendors. I did want to highlight M&A and kind of personal asset protection. I'll do that quickly. So in the M&A space, we find that a lot of technology companies have significant kind of risks as they go through kind of the buy-sale experience. And along with that purchase, we just want to make known that the costs to purchase reps and warranty related policies. Many of you represent certain terms as respects to your companies and warrant against certain things has decreased tremendously. And many investors or technology companies, as they look to sell or buy, really haven't looked at reps and warranty policies in the past, primarily due to the fact that IP was not covered. So inappropriate or not really doing enough discovery on the patent portfolio and the risks associated with that, that's a risk that can actually be covered today, thereby significantly reducing kind of some of the risks that companies have been warranting or representing against. The final thing that I'll mention on personal asset protection is we talked about D&O, directors and officers liability, and how it protects you against your fiduciary duty. I did want to mention kind of personal risks not associated with that duty as a director, officer, or company are not covered by standard commercial policies. And so certainly as you consider your personal policies with your personal assets as respects to homeowners, auto, et cetera, umbrella policies, any fine art you may have, jewelry, et cetera, things of that nature, just want to highlight it's important to take a glance at those types of risks and those policies as well. I do want to address another question that came up. So there's a question that came up. I'll go ahead and just read it. Sometimes a company is covered under GL and Tech E&O policies in the ways a cyber liability policy would serve. Yet some customers want to see a cyber liability policy with an endorsement and named insured. How would you demonstrate compliance to a customer? It's a good question. So there are ways to purchase elements of cyber liability through a package policy where your package carrier, the GL carrier, as this individual astutely mentions, can provide some elements of E&O coverage. Generally, that's limited coverage, but it is still coverage and, to your point, can demonstrate compliance to a customer. When a customer requires a need to see the cyber liability policy and the endorsement with the named insured, we oftentimes will ask a client to push back on that, only because the need to see a policy, the policies just change, and the nature of how policies are distributed. Policies generally come 60 to 90 days after renewal, and sometimes the timing just isn't ideal. But if you're unable to kind of remove that contractual requirement, that is something in terms of providing value to that, in terms of evidencing that coverage, that is something a broker can do. If it's an absolute mandate to provide a policy, a broker can provide value there. Certainly the endorsement or the named insured, those are all things that can be done on a policy and can provide some value there. So that should be pretty simple, but it would be my recommendation if this requirement comes to push back on it. You may elect to purchase a $10 million cyber liability policy or through a GL or done by endorsement, however you elect to purchase it, but it's $10 million a limit. And your client may only require you to buy $1 million. So if they're going to ask to see your policy and you're going to expose to them the fact that you buy $10 million, that might be unnecessary risk that you might not want to take on. So there's a lot of reasons to kind of push back against that, but good question. All right, I'm going to go ahead and move on. So one of the things that we're finding is obviously the world is becoming much more dependent upon technology, and the nature of how technology is providing value in terms of being critical to your client's business is increasing. As a result, we find that technology companies are really, most technology companies we find have a limitation of liability. This is not an insurance clause, right? This is just a limit of liability that says, hey, if our technology is anything it's not supposed to do, we're going to cap your ability to litigate or to sue us generally equal to the value of our contract over a one-year period. Some technology companies enhance that. Some technology companies, particularly subscription services, provide perhaps 3 months or 6 months of limitation liability. The point that I'd like to highlight here is that we find that our technology clients are struggling with this negotiation. Particularly as you deal with larger customers, customers say, hey, if you're going to limit your liability to one-time revenue, that's just not going to work for me. I need significantly more limitation liability. In fact, if you're doing a lot of business in the financial institution space, the healthcare space, or the government space, it wouldn't be uncommon to have your customers request unlimited liability. Basically saying, hey, look, if something goes wrong, we want to be able to sue you as much as we can, right, with no cap. And certainly, there's no desire to put that much at risk if you're responsible for the risk program, either a general counsel or CFO of an organization. In addition, we find that our general counsels are spending just an inordinate amount of time negotiating these contracts, and it's just taking a lot of time. So I'm going to give you just a quick snapshot of some of the counsel we're providing companies who are struggling with this issue of limitation liability. And then again, happy to entertain any questions. So why don't I use that Oracle example, if that's okay. So Oracle approaches Crystal and says, hey, we want to be your HR vendor and provide you services. And we're going to limit our liability to the value of the contract. Let's say it's a $100,000 contract, just for the sake of numbers. And Crystal and Company, we're an astute kind of risk management firm, so we say, hey, that's not going to work. $100,000 is far too little. You have the personally identifiable information of all of our employees, and you're running our performance kind of modules, et cetera, our KPIs. You're just too important. And we push back on Oracle, and we say we want 10x. Well, Oracle now has this decision. Let's say it's their cloud platform, right? If Oracle provides the 10x limitation liability, in this case $1 million to Crystal and Company, and there's a breach or an outage that happens, clearly the risk associated with Crystal and Company is increased by tenfold, right? If it's a cloud-related event, what we find is that although it would be rare that an event would happen only for one customer. And so if Oracle is increasing their limitations of liability across their customer pool, we have an aggregation issue where the limitations of liability stack on top of each other, and this original 1x limitation liability that has become 10x is now, there's now 100 contracts out there that are at 10x each. It can be a company-ending event particularly for a smaller technology company who is heavily reliant upon AWS, who had multiple outages last year, or another cloud vendor, or even just, it doesn't have to be a cloud provider, it could be just a vendor of yours that provides value to you. It could be just a software error that caused a problem for each of your customers. It could be a security failure. There's a variety of ways in which these limitations of liability can be evoked. So coming back to this experience between Oracle and Crystal and Company, by the way, not a live example. However, we have enabled companies like Oracle to come back to Crystal in the example I just described. So for example, when Crystal requested the 10x limitation liability, we've enabled a company like Oracle to go back to Crystal and say, hey, we appreciate your desire and need for 10x limitation liability. We have a solution for that. It's called I'll just make this up, the Oracle Plus contract or the Oracle Gold contract. This advantage contract to you can provide you your desired 10x limitation liability. However, at the expense of, I'm just going to use an arbitrary number, of $1,500. Now what we find is that when that occurs, generally Crystal and Company will negotiate. We'll say, okay, well if 10x is $1,500, what is 5x? And what we've done is we've quantified the risk associated with the 9x in addition to the 1x original limitation liability. We've quantified that to $1,500. And we have something to negotiate. Now that quantification comes through actuarial science. And it enables kind of a contract to flow quickly. I'm sure some of you general counsels have had the experience of the sales guy knocking on your door saying, I'm trying to close this contract, hurry and negotiate the terms, right? And perhaps, for those of you that are CFOs, you're saying, hey, let's get the cash in the door faster, right? What we find is this process really facilitates contract and cash flow to happen faster. Now the $1,500, that is independent of insurance or anything. However, clearly the actuarial science can be built such that $1,500 will offload that 9x, that additional 9x that Oracle is taking on for the Crystal contract to an insurer. So we've quantified the risk, we've offloaded the risk to an insurer, and we've facilitated the contract. Now, I'm aware of many general counsels, particularly here in Silicon Valley, who have taken this to one kind of additional level, where if, for example, the premium was $1,500 in this case, they're charging $10,000 and they become profit centers. Most importantly, this is facilitating contracts. There's one general counsel here in Silicon Valley, a very kind of prominent startup, who was spending 10 hours a week negotiating limitation liability contracts. With kind of this model that I just described, he reduced it to 4 because he took all limitations liability for him greater than 3x and handed the model that we provided to them and gave it to his contract manager. It's a contract manager. Anything 3x and below, just use this model and charge. Just push contracts. And anything beyond that, I'll deal with the larger customers. Our clients have appreciated this. I heard one general counsel mention that our ability to offer additional limitation liability is a direct reflection on our belief in our security. So if we believe in our security, I'd like to offer more, but I don't want to put the company at risk. So having, in this case, an insurance vehicle, or at the very least, an actuarial model that can help me quantify the risk and offload the risk as appropriate can be interesting. Final point, there may be some of you that say, hey, the cost of my services it's price elastic, right? I can't really offer I can't charge an additional $1,500. Well, that's where the model can actually be quite helpful. The actuarial model where someone says, hey, I'm not willing to pay $1,500 for that 10x. I really just need 10x. Well, you can look at the model and say, well, we've looked at your contract and the revenue size of your company and the amount of risk that we have. And through actuarial science, we think there's a 1 in 200 year event that we will hit $6 million of risk. Now, I understand you want 10, but based upon this data, how about I give you 8 and let's call it the day? Now, granted, it's still $8 million of limitation liability in the example I gave, or excuse me, I keep saying million, it was actually 800,000. However, it's not 10, and you save the company kind of 2x in terms of this contract. There's a question that was just raised around, do we need a specialized broker to add on coverage for higher limitations of liability? The limitation liability exposure, depending on what you're offering in your contracts, can be covered under the technology errors and omissions policy. This is something we spend a lot of time in. I wouldn't necessarily say you need, quote unquote, a specialized broker. However, I would say that you need a broker who really understands technology and understands that if you're offloading liability for patent exposure you may have, that may be something far more difficult to cover than simply the privacy aspects that are there. Again, not impossible, but it's just something to kind of distinguish. And this is really based upon technology risks in terms of brokerage expertise, but a good question. All right, I'm going to go ahead and move on again, and I'll do this slide relatively quickly. I did want to address patent-related risks. It's a growing risk, arguably one of the more significant risks for a technology company. It's something that we've innovated on in terms of building a product. Now, this is not the Oracle, Google, the Samsung, Apple-related risks that we're discussing. And I'll distinguish that by calling that competitor risks. Competitor risks, when a technology company like Apple and Samsung sue each other for patent infringement, it is very emotional. They are looking to take each other out of business. And the costs associated with that, frankly, the standard deviation is just incredible. Like, it's very difficult to model, and as a result, difficult to insure. However, many of you are familiar with this concept of a non-practicing entity or a patent troll related risk. And so a patent troll is generally an entity who has no revenue, no employees. Most of these cases are filed in the Eastern District of Texas. These are generally entities who have purchased patents on the open marketplace. There is a brokerage market for patents. When these patents are sold, they're generally sold. Their sales sheet has the companies who may be infringing on the patent, because frankly, the only way to monetize a patent, if you're a troll, is through litigation. So they'll purchase these patents, and generally within 90 days will litigate a variety of companies who infringe on that. It's definitely most specific to technology companies, although, you know, Target stores, well, all e-commerce platforms have litigation. United Airlines, we're seeing banks, financial institutions with mobile banking getting litigation. On the left side of this chart, we show kind of the monthly campaigns over the past 13 months, excuse me. Average number of defendants is double digits. So there are many, many companies that are getting sued in each of these kind of campaigns. On the right side, you can see kind of the distribution of kind of technology sectors that are getting hit. And unfortunately, no surprise, e-commerce and software are by far the majority here. They are getting tagged by these patent cases more than anyone else. The reality is patent trolls, otherwise known as non-practicing entities, they have one goal in mind when they go out and litigate, and that is to receive a settlement. It's a finance game for them. They're not looking to take a company out of business. And because of these factors, we were able to model the risk. And through this partner, you can kind of see the source here is a company actually based in San Francisco. It's a public company, RPX. We built an insurance company with them where they are able to provide meaningful coverage around patent troll related risks. And this is something that's very tailored for startups, for smaller technology companies, on up to even larger technology companies, but can certainly alleviate any concerns you may have around patent troll related risk, which generally, for companies below $1 billion in revenue, is about 80% of the litigation we see on the patent side. All right. I'm certainly happy to answer any questions we have there. I apologize because there was, in fact, I may just take this question on the end. There was another question about limitation liability. Let me go ahead and kind of just move to our last slide. I recognize that today I addressed a variety of insurance matters and may have caused you to wonder whether or not you know, some of these coverages exist on your policies. Or what might be the costs associated with them? Or what does it mean to kind of add these coverages? How do I know I have valuable coverage? Crystal and Company, we've developed, specific to the technology industry, a diagnostic around policies. And for Insight and for their portfolio, we are offering kind of just the opportunity to provide this diagnostic service. You can think of it as an audit of your policies, complimentary at no cost, and we'll do that specific to your portfolio. And you can see we kind of just use this Amazon star system, and we rate each policy on 7 different terms. In this case, we show an example for executive liability, or D&O, and you can see kind of the 7 areas of the policy which we will address. Now, 3 stars, it's not ABC, it's not like school. 3 stars means that your policy is in line with kind of the market, and obviously anything above is positive, anything below is negative. Unfortunately, where we find the most meaningful problems on a policy are the primary coverage terms. Most notably, for example, over the past year, we have reviewed many policies that did not include coverage for third-party hosting providers. So, for example, if you're leveraging a third-party infrastructure such as AWS, Microsoft, or another cloud provider, we've seen many policies that say, hey, if something happens to that third party, we're not going to provide coverage for you. And that's largely the purpose of many of the reasons why technology companies purchase the policy, just to give you a snapshot of some of the problems we see. So again, I'll show you some contact information in a second, but we'd like to offer this to any of you that have interest. I'll go ahead and go to the next slide just as a conclusion, and I'll address the last question that I see in the platform, and then also just entertain any other questions you may have. So the question was, regarding limitation liability, are companies really successful in having fully capped, no carve-out for things like indemnity or breach of confidence, which major enterprises would be interested to find out if these pass-through premium clauses work with these enterprise clients? So first of all, the example that I gave, that was very much done for large clients. We had, I won't say the name, a very notable technology company that provided SaaS-based services that collected a lot of private information, and the general counsel said, limitation liability is the bane of my existence, which I thought was interesting. He just detested it and was looking for a solution where he could negotiate with some degree of power, because I mean, this was a good-sized company, probably about $80 million at the time. They're now well over $500 million, but $80 million at the time, and said, I don't feel like I have any leverage, any negotiating power. And so his ability to offer this advantage contract through this compensation methodology, he did not attempt to make a profit. He was just trying to offload the risk to an insurer. Quantifying the risk through actuarial science gave him the confidence to negotiate, and I wouldn't necessarily say a position of power, but a position of more power. I think the key part of this question was really the question regarding a fully capped, meaning no carve-outs, and that is more difficult. I think generally what I find, technology companies' contracts have carve-outs, most notably for things like patents. You know, if you get tagged for patent exposure, you know, we don't expect you to have to pay that, right? We will take that on. In other areas like privacy or any type of confidential information, any type of technology failure, those are generally things that are very easily covered. And so in your negotiation, it is generally not, quote unquote, a fully capped with no carve-outs. However, in conjunction with your contract, that's certainly something that can be covered. By the way, as you look to an errors and omissions policy, it's important that the broker and the insurance carrier have some sense of what your standard contractual terms are. That's a key underwriting criteria for this policy. And so having some insight from your advisors, obviously the broker wouldn't act as an attorney, but having some insight on what other technology companies are doing, or other from your insurance carrier, that can be valuable. And certainly that's something that we can do in conjunction with that policy audit, is just provide you a little bit of insight on your contract. Again, not as legal advice, but simply as to what we're seeing in the marketplace. All right, that was a good question. Are there any other questions that you would like addressed? So I see one more. Will you be providing a copy of this presentation to the participants? Yes, we have no concerns with that. Happy to provide a copy of the presentation. Maybe just in conclusion for myself, and I'll entertain any other questions as they come in. It's been a pleasure for myself and for Crystal and Company to associate with Inside Venture Partners and have the opportunity to provide you just a bit of insight on risk and insurance for the technology industry. You have contact information here of our principal. Happy to answer any additional questions offline or at any point in the future. So I appreciate your time today. And Blair, with that, I'll go ahead and turn time back over to yourself.
Okay, thank you, Sean. That was really terrific. Better than I even expected, and my expectations were high. So thanks to the Crystal team, and I want to thank everyone again for joining. If you have ideas for potential future webinar topics that you think would be useful to you personally or across the portfolio, we urge you to please feel free to contact me or Mark Lessing. You can shoot them to us by emails. You can talk to us about them when you next speak to us. One of the things we're here for is to try to present these things that will be valuable to people in their day-to-day work. And again, if you have questions about today's contact, please feel free to direct them to me or to someone at Crystal. With that, I will wish everyone a great rest of the day and a great weekend, and look forward to working with you all again soon. Bye now.